In Haiti, the hurricane dumped such heavy rain there is extensive flooding across the country. At least 25 people there have died and others are missing. One death has also been confirmed in the Dominican Republic. And it barreled through Cuba overnight, causing widespread damage there. Jamaica's leader posted these aerials of the devastation in his country. 8 deaths have been confirmed, and much of Jamaica is without power and difficult to access. Jackson Prosco has our top story tonight.
Jamaicans awoke to devastation. Homes are gone, hospitals flooded, the landscape forever changed.
A lot of my friends' house is gone. Nice home.
In Black River, where the storm made landfall, there is catastrophic damage.
Yesterday it was very windy, scary. We have to run all the way up to my daughter and my next daughter home for safety.
77% of the island is now without power. Communications have largely been cut off, leaving officials with little sense of who may be missing or who may need help.
At the moment, what we're seeing in preliminary assessments is a country that's been devastated to levels never seen before.
Hurricane Melissa roared onto the island as one of the most powerful Atlantic hurricanes on record.
It's terrible. The wind, it was violent. It was terrible.
Though the worst missed the capital of Kingston, wicked winds tore across the western part of the island, while torrential rains caused flash flooding in the mountains.
It was terrifying for me and my child. The water level reached me to my waist. I was stuck in my house. They had to break into my home to save me.
The storm then sliced through Montego Bay, a popular destination for tourists.
You can see that it's a little bit of a waterfall in here right now.
In Haiti, Melissa's torrential rains turned deadly as a swollen river burst its banks. The storm then made a second landfall early Wednesday in Cuba, losing some strength but still delivering a wallop as a Category 4. Now Melissa is taking aim at the Bahamas after leaving behind a trail of destruction that will scar these island nations for years. Jackson Prosco, Global News, Washington.
Just months after Florida's housing market hit a 14-year inventory high and median home prices plunged below $415,000, the governor declares a state of emergency. Hurricane Melissa, a potential Category 4 monster, is bearing down on a state already crippled by $200 billion in storm damages and an insurance crisis leaving 1 in 5 homeowners unprotected. Could this be the final blow that destroys the entire market? The answer begins with what the governor knows and what the data reveals next. Florida's housing market, already battered by years of storms and soaring insurance costs, stands at a precarious point. As of May 2025, the statewide median home price is $415,000. A 2.7% decline from the previous year. Inventory has surged to a 14-year high, reflecting a flood of properties with few willing buyers. In Cape Coral and Fort Myers, more than 12,000 homes are listed for sale, a volume not seen since the last major bust. Sanibel Island tells a sharper story. Median home prices have collapsed from $1.3 million before Hurricane Ian to $830,000 this spring, with many listings lingering for months. St. Petersburg and Sarasota have seen projected home price drops of 10%, while pending sales across the Gulf Coast are falling through as buyers hesitate in the face of mounting risk. In these vulnerable regions, months of supply numbers have doubled, and realtors report a wave of sellers trying to exit before the next disaster. Miami-Dade and Broward counties, once magnets for out-of-state buyers, now confront rising inventories and stalled deals, especially in older coastal condos. Across the state, properties in flood zones and buildings lacking updated wind codes are hardest hit, with cash buyers and investors the only active market players. The numbers reveal a market under siege, not just from storms, but from the relentless pressure of insurance woes and a shrinking pool of buyers willing to gamble on Florida's future. The financial wounds from past hurricanes run deep across Florida's landscape. Over the last several years, storms like Ian, Helene, and Milton have left a trail of devastation that extends far beyond ruined homes and battered coastlines. The total economic toll from these events has now surpassed $200 billion statewide, according to NOAA and insurance industry records. Hurricane Ian alone accounted for $112 billion in damage, making it the most expensive storm in Florida's history. Each new disaster compounds the strain on communities already struggling to recover, pushing more homeowners to the edge. Infrastructure repairs lag behind, insurance payouts drag on, and the cost of rebuilding climbs higher with every season. Cities like Fort Myers and Cape Coral are still dotted with unrepaired roofs and shuttered businesses years after landfall. For many, the hope of a full recovery has faded into a slow acceptance of permanent loss. This relentless cycle of destruction and rebuilding has drained public resources, forced local governments to cut services, and left thousands of families in limbo. The burden of these accumulated losses weighs heavily on the state's economy, setting the stage for even greater vulnerability as the next hurricane season approaches. Each storm leaves less room for error, less financial cushion, and fewer options for those living in harm's way. Hurricane Melissa began as a tropical wave drifting westward off the coast of Africa, Yarbathi, gathering strength over waters that were warmer than usual for late October. Meteorologists at the National Hurricane Center tracked its progress as the system rapidly organized, taking advantage of Atlantic temperatures running 2 to 3 degrees Celsius above normal. By the time Melissa passed the Lesser Antilles, forecasts showed a storm with the potential for explosive intensification, a scenario that had played out with growing frequency in recent years. NOAA advisories issued on October 24th placed much of Florida within the forecast cone, with model graphics displaying a wide range of possible tracks. Some ensemble members pointed Melissa toward the Gulf Coast, while others nudged it east toward the Bahamas. The consensus at that stage was anything but certain. The possibility of a Category 3 or 4 landfall loomed, and the threat window forced emergency planners and homeowners into action. Early intensity models suggested wind speeds could reach 130 to 145 miles per hour if Melissa maintained its course and continued feeding off the unusually deep reservoir of warm water. As the storm approached Jamaica, satellite data showed a compact, well-defined eye and a growing wind field. The system intensified to Category 5 status with sustained winds of 185 miles per hour, devastating parts of Jamaica and raising alarms across the region. Yet, the question of where Melissa would go next remained unsettled. Each new model run brought subtle shifts in the projected path, with some scenarios steering the storm into the Florida peninsula, while others showed a sharp turn to the northeast. By October 27th, the forecast picture began to change. The arrival of a mid-latitude trough over the southeastern United States started to influence Melissa's trajectory. Guidance from the National Hurricane Center narrowed the cone eastward, reducing the probability of a direct Florida impact. Still, the ensemble spread kept meteorologists and emergency managers on edge. The official NHC discussion warned that even a slight change in steering currents could bring catastrophic winds and flooding to Florida's Gulf Coast. Local officials in Tampa Bay, Sarasota, and Fort Myers watched the updates closely, knowing that a wobble of just 50 miles could mean the difference between a near miss and a direct strike. Over the next 48 hours, model consensus firmed up. The forecast cone shifted steadily away from Florida, with the most likely track carrying Melissa across the Bahamas and out into the open Atlantic. NOAA advisories on October 30th confirmed the trend. Melissa was now accelerating northeast, with the center expected to pass northwest of Bermuda. Reconnaissance flights and satellite imagery confirmed weakening as the storm moved over cooler waters and encountered strong wind shear. The evolution of Melissa's track illustrated the challenges of hurricane forecasting in an era of rapid intensification and shifting climate patterns. Early cones had forced millions in Florida to prepare for the worst, but the final model ensemble revealed a narrow escape. The uncertainty embedded in each forecast, visible in the spread of model graphics and the language of official advisories, underscored just how much can change in a matter of days. For Florida's real estate market and its anxious homeowners, Melissa became another lesson in the unpredictable, high-stakes reality of hurricane season. Storm surge and rainfall projections are the backbone of hurricane risk assessment, and for much of October 2025, Florida's emergency management teams watched the latest SLOSH and QPF model runs with a sense of dread. Early in the advisory cycle, as Hurricane Melissa charged across the Caribbean, the threat maps painted a stark picture. SLOSH, a model that simulates storm surge based on hurricane strength, speed, and track, outlined potential inundation zones along Florida's Gulf Coast, from the barrier islands off Sarasota to the low-lying neighborhoods of Cape Coral and Fort Myers. In these scenarios, surge heights of 10 to 15 feet were not just possible, but likely, for communities at or near sea level. Tampa Bay's unique geography, with its broad, shallow estuary, appeared especially exposed. Model overlays showed that a direct hit could drive water deep into downtown Tampa, flooding residential blocks and critical infrastructure alike. Quantitative precipitation forecasts, or QPFs, layered on another dimension of risk. Early runs suggested rainfall totals of 15 to 25 inches for central and southwest Florida if Melissa's core passed over land. These numbers meant not only coastal flooding, but catastrophic flash floods far inland. Places like Lakeland, Orlando's western suburbs, and the riverine communities along the Peace and Caloosahatchee. In neighborhoods still scarred by Hurricanes Ian and Milton, the prospect of another deluge threatened to erase years of slow recovery. Floodplain maps, updated after each major storm, showed that thousands of homes in Lee and Collier counties now sit within high-risk zones, where even moderate rainfall can overwhelm drainage systems. The surge and rain overlays did more than outline physical danger. They translated meteorological data into hard numbers for emergency planners and homeowners. In St. Petersburg, SLOSH maps indicated that entire blocks of historic bungalows could be under several feet of water if the storm tracked just a few miles west. Sarasota's barrier islands, already battered by previous hurricanes, faced scenarios where evacuation would be mandatory and return uncertain for weeks. In Miami-Dade and Broward counties, while not in the bullseye for surge, the QPF models signaled urban flooding risks that could cripple transportation and emergency services. Across the Space Coast, from Palm Bay to Titusville, rainfall overlays showed the potential for widespread inundation, with stormwater retention ponds and canals likely to overflow. These models provided the numbers that underpinned every evacuation order and emergency declaration. They drove decisions to close schools, reroute hospital patients, and pre-position National Guard units. For real estate agents and insurers, the overlays became a grim map of exposure, identifying which zip codes were likely to see the steepest drops in value and the greatest risk of uninsured loss. In the days when Melissa's path still included Florida, these surge and rain forecasts put a spotlight on the communities standing in harm's way. The threat was not abstract, but measured in feet of water and inches of rain, mapped block by block, house by house. Even as the forecast cone shifted away, the lesson from the overlays remained. In Florida's most vulnerable neighborhoods, the distance between safety and disaster is measured in miles, or sometimes just in inches. Homeowners across Florida face a mounting dilemma as insurance premiums climb to record highs and options for coverage dwindle. The average annual premium now stands at $5,376, over twice the national average. In many coastal and inland neighborhoods, rates have spiked even higher. with some policyholders reporting bills above $10,000 per year. For families living on fixed incomes or already stretched by rising mortgage payments, these numbers have forced hard decisions: pay the premium, drop coverage, or risk going uninsured. Recent filings with the Office of Insurance Regulation show double-digit rate hikes from nearly every remaining private insurer, with some companies requesting increases of 30% or more for the coming year. The surge in costs comes as more than 30 insurance carriers have withdrawn from Florida since Hurricane Ian, citing unsustainable losses and the threat of future storms. In 2025 alone, at least 5 more companies announced plans to exit or sharply limit new business, leaving entire zip codes without private options. The exodus has left a growing share of homeowners with nowhere to turn but Citizens Property Insurance Corporation, the state-run insurer of last resort. Citizens now manages 1.4 million policies, a number that has more than doubled since 2021. Yet even this public backstop is under strain, with board meeting minutes revealing concerns about its ability to absorb another major event. With so many private carriers gone, the insurance gap continues to widen. By spring 2025, an estimated 15 to 20% of Florida homeowners were uninsured, locked out by unaffordable premiums or outright refusals to write new policies in high-risk areas. Lenders, meanwhile, have tightened requirements, making it nearly impossible to close on a home without proof of coverage. In some coastal counties, agents report entire blocks where no private carrier will issue a new policy, regardless of upgrades or mitigation efforts. For sellers, this means deals collapse at the last minute as buyers lose financing or walk away, wary of taking on an uninsurable property. The cycle feeds on itself. Each insurer that leaves the market puts more pressure on those who remain, forcing higher rates and stricter underwriting. Citizens, designed to be a temporary solution, is now the default for hundreds of thousands, but its financial resources are finite. If another major hurricane were to strike, actuarial models warn that the cost could overwhelm both Citizens and the Florida Hurricane Catastrophe Fund, triggering statewide surcharges on all property and auto policies. For many Floridians, the question is no longer whether they can afford to rebuild after a disaster, but whether they can afford to keep their homes at all. Citizens Property Insurance Corporation now covers 1.4 million policies, its largest exposure since Hurricane Andrew. The company's surplus stands at just over $3.6 billion, with $1.6 billion in cash, figures that seem robust until measured against the scale of a major hurricane. Citizens Reinsurance Tower, assembled in a tightening global market, provides about $3 billion in coverage above a $4 billion retention for personal lines, with less protection for commercial accounts. If losses exceed these layers, the responsibility shifts swiftly back to Citizens and ultimately to Floridians. The Florida Hurricane Catastrophe Fund, known as the CAT Fund, is the next buffer. With $17 billion in claims-paying capacity projected for 2025, the CAT Fund reimburses insurers, including Citizens, after large events. But this is a ceiling, not a guarantee. Once statewide insured losses surpass $17 billion, the CAT Fund's resources are depleted, and the state must levy assessments to replenish it. These surcharges appear on nearly every property and casualty insurance policy in Florida, from homeowners to auto, distributing the cost but making it unavoidable. Citizens' own assessment triggers are set by statute. When claims from a catastrophic event outpace its surplus, reinsurance, and CAT Fund recoveries, the board is required to impose emergency assessments. These can reach up to 45% of annual premiums, phased in over years, and apply to almost all policyholders statewide. In a $20 billion hurricane scenario, Citizens' surplus would likely suffice, avoiding assessments. At $50 billion, the surplus evaporates, reinsurance is exhausted, and a multi-year assessment, possibly $10 to $20 billion, becomes necessary. A $100 billion event would trigger maximum surcharges and a deficit that could take a decade or more to repay. At $150 billion, the statutory cap is breached, leaving the system with a deficit larger than any previous event in Florida's history. The CAT Fund operates under similar constraints. Once its resources are gone, it triggers its own assessments, certified by the Office of Insurance Regulation. The process begins months after a storm, as claims settle and reinsurance payments are processed, but the financial impact can linger for years. After Hurricane Wilma and the 2004 to 2005 storm cycle, Floridians paid surcharges for nearly a decade to refill the fund. Citizens cannot legally fail, but when obligations exceed available cash and capital markets close their doors, claims may be delayed and policyholders left waiting. The legal backstop ensures payment, but slow pay and drawn-out litigation become real risks. Private carriers, in contrast, can be placed into rehabilitation or liquidation, with the Florida Insurance Guarantee Association stepping in. Another cost ultimately borne by policyholders. The National Flood Insurance Program faces its own caps and assessment structure. Many Floridians only learn after a storm that standard homeowners' policies do not cover storm surge flooding, leaving gaps that no public backstop can fill. Each hurricane narrows the margin for error. The state's safety nets are finite, and with every landfall, the risk of systemic insolvency becomes more tangible. MLS data from late October 2025 captured a sudden, sharp rise in new listings across Florida's coastal counties. In Cape Coral and Fort Myers, the number of homes for sale jumped by nearly 1,500 in just 4 days. Agents reported that many of these properties came from owners who had held off for months, only to panic list as Hurricane Melissa's track briefly threatened the state. The effect rippled through the market. Pending sales fell apart almost overnight, with buyers invoking force majeure clauses or simply refusing to close. In St. Petersburg and Sarasota, the condo market was especially hard hit. More than a quarter of all active condo listings were withdrawn or relisted as cash only, reflecting a growing reality. Lenders would not finance properties in high-risk zones without ironclad insurance, and insurance was either unavailable or unaffordable for most. One Cape Coral agent described the mood as total gridlock. She scrolled through her MLS dashboard, 12,000 homes on the market, but not a single showing booked since the first hurricane warnings. Sellers called in tears, asking if they should cut prices further or pull their homes off the market entirely. In her words, it's like the whole market just froze in place. No one wants to buy, and everyone wants out. This freeze hit condos hardest. In Pinellas and Lee counties, the percentage of cash-only condo listings surged to 38%, up from 22% the previous quarter. Older buildings, especially those constructed before the latest wind codes, faced a near-total collapse in financing options. Condo associations scrambled to meet new reserve requirements, with some boards voting on emergency assessments of $75,000 or more per unit. Many owners, especially retirees on fixed incomes, found themselves boxed in, unable to sell, unable to afford the new costs, and unable to insure their homes at any price. The rush to list wasn't limited to the coast. Inland, in places like Lakeland and Kissimmee, real estate agents fielded a wave of calls from anxious owners wanting to get out before it's too late. But buyers already wary of rising insurance premiums and the possibility of another major storm were few and far between. Investors, particularly those with cash on hand, began circling the hardest-hit markets, looking for distressed deals. Yet even they hesitated, waiting to see if the insurance market would stabilize or collapse entirely after Melissa's threat passed. For ordinary homeowners, the result was a market that felt both crowded and empty. a glut of listings, but no real way out. The sense of vulnerability spread far beyond hurricane tracks, touching every corner of the state's real estate economy. Investor capital has become a defining presence in Florida's battered housing market, especially in the wake of repeated hurricane threats and the insurance crisis. As traditional buyers retreat and homeowners scramble to list properties, institutional funds and private equity groups are quietly amassing cash, waiting for the right moment to strike. Blackstone, Pretium, and other national players have already mapped their zip code targets, focusing on the hardest-hit corridors of Cape Coral, Fort Myers, and the older condo towers of Miami-Dade. Their strategy relies on speed and scale, bulk purchases of damaged or cash-only listings, often at discounts of 30% or more, from pre-storm values. This influx of outside capital promises a rapid injection of liquidity, but it also reshapes the recovery timeline. Local agents report that investors are less interested in community rebuilding and more focused on return. Flipping storm-impacted homes or renting them out at premium rates as soon as repairs are complete. For long-term residents, this means competing with well-funded buyers who can pay cash, absorb insurance shocks, and wait out permitting delays. The result is a market bifurcated by access to capital. Those with resources can rebuild, while those without may be forced to sell at a loss or walk away entirely. The cost of reconstruction itself is another hurdle. The Construction Materials Index for Florida has nearly doubled since Hurricane Ian, driven by ongoing supply chain disruptions and surging demand after each disaster. Plywood, roofing, and concrete prices spiked again in the days surrounding Hurricane Melissa's threat, with some distributors rationing inventory to large buyers. Labor shortages compound the problem, as contractors are booked out months in advance, and specialized trades are in even shorter supply. For many homeowners, the wait for repairs stretches well beyond a year, especially for those navigating insurance disputes or new code requirements. Forecasts from building industry groups suggest that the average cost to rebuild a storm-damaged home in coastal Florida could rise by another 30 to 40% over the next 3 years. In places like Sanibel, where permitting backlogs are notorious, the timeline for a full neighborhood recovery now ranges from 3 to 5 years. Some investors see opportunity in this drawn-out process, anticipating that properties acquired at post-storm lows will appreciate sharply once repairs and upgrades are finally complete. Others, however, warn that persistent insurance gaps and the risk of future storms could trap capital in a cycle of repeated loss. For local governments and the broader economy, the stakes are high. Investor-driven rebuilding can stabilize property values in the short term, but it may also accelerate the displacement of long-term residents and shift entire neighborhoods toward absentee ownership. The path forward is uncertain, shaped by the push and pull of capital, the soaring costs of materials, and the ever-present risk of another catastrophic storm. Evacuation orders swept across Florida's Gulf Coast as Hurricane Melissa's early forecast placed millions of residents in the crosshairs. Emergency managers activated the largest mobilization since Irma, with state officials urging up to 3 million people to leave vulnerable zones. Highways out of Tampa, Fort Myers, and Sarasota clogged with traffic, as families packed cars with essentials and pets, hoping to reach safer ground before the storm's outer bands arrived. Gas stations along I-75 and I-95 ran dry within hours, forcing drivers to wait in lines stretching around the block or search for fuel in neighboring counties. Hotels from Gainesville to Atlanta filled rapidly, with digital reservation boards flashing no vacancy by midday. FEMA teams moved into staging areas near Orlando and Tallahassee, hauling in truckloads of bottled water, MREs, and medical supplies. Pallets of emergency rations lined the floors of converted sports arenas, while mobile command centers buzzed with radio chatter. The National Guard deployed thousands of troops to coordinate traffic, assist with evacuations from nursing homes, and prepare for possible water rescues. Helicopters idled on tarmacs, ready to airlift the most vulnerable once the winds subsided. Hospitals in the projected impact zone raced to transfer patients inland. Ambulances carried critical cases to facilities in Ocala and Jacksonville, while field hospitals stood by to receive overflow. School districts across central and southern Florida closed campuses, converting gymnasiums into temporary shelters for evacuees who had nowhere else to go. University dormitories emptied as out-of-state students boarded buses north, some uncertain when or if they would return. Major airports announced plans to suspend operations, grounding flights as Melissa's path remained uncertain. Cruise ports in Miami and Tampa canceled departures, stranding thousands of travelers. Theme parks shuttered gates, posting digital updates for anxious tourists. Meanwhile, supply chain managers at Home Depot and Lowe's scrambled to keep up with surging demand for plywood, generators, and sandbags. Store shelves emptied in hours, with new shipments diverted from neighboring states to meet the crush of last-minute shoppers. For many, the evacuation was a test of endurance. Cell phone alerts buzzed with changing instructions as the storm's track shifted east. Families spent hours crawling north on gridlocked highways, some running out of fuel before reaching safety. Emergency shelters filled to capacity, with volunteers working overtime to process new arrivals. In the chaos, FEMA crews and National Guard units became the backbone of the response, distributing supplies, directing traffic, and preparing for the long days ahead. The scale of movement and coordination strained every system, revealing both the strengths and limits of Florida's disaster readiness, as Hurricane Melissa loomed offshore. A storm on the scale of Hurricane Melissa would expose the full economic fragility of Florida's housing market. Catastrophe modeling by FEMA and private risk firms projects that a direct hit on the Gulf Coast or Tampa Bay, regions with tens of billions in built-up real estate, could drive total economic losses far beyond $200 billion. If the storm's surge and rainfall mirror the worst-case scenarios seen in past hurricanes, total damage could reach $300 billion. This figure includes not only insured losses, but also the vast shadow of uninsured damage, business interruption, infrastructure collapse, and the cost of mass displacement. The ripple effects would be immediate and sweeping. In the weeks after landfall, as many as 400,000 jobs could vanish statewide. Temporary unemployment would spike across construction, hospitality, retail, and public services. Tourism, a $112 billion pillar of Florida's economy, would be paralyzed if airports, hotels, and theme parks remained shuttered. Local governments, dependent on property taxes, would face budget crises as home values crater and tax rolls shrink. School districts and public safety agencies would confront layoffs or service cuts, compounding the hardship for families already struggling to recover. State lawmakers and policy experts face a daunting menu of options. Some urge the creation of a state or federal reinsurance pool to stabilize the insurance market and prevent further exits by private carriers. Others push for expanded buyout programs, offering homeowners in the most vulnerable zones a path to retreat before the next disaster. Stricter building codes and mandatory retrofits could reduce future losses, but would impose steep costs on owners of older homes and condos. Fast-tracked grants and low-interest loans might speed up repairs, but risk administrative bottlenecks and fraud if not tightly managed. Legislative drafts circulating in Tallahassee reflect these trade-offs. One proposal would cap post-disaster insurance surcharges to limit the financial pain for policyholders, while another would raise the cap to shore up citizens' property insurance's reserves. Industry lobbyists warn that too much regulation could drive the last private insurers out of Florida altogether, leaving the state to shoulder even greater risk. Consumer advocates, meanwhile, demand premium relief and greater transparency about insurer solvency. The choices ahead are stark. Stabilize the market with public funds, force painful reforms, or risk a housing and insurance collapse that could take years to unwind. Each option carries costs, but the alternative, inaction, threatens a downward spiral for Florida's economy and the millions who call it home. As of May 2025, Florida's median home price had already dropped to $415,000, with inventory at a 14-year high and over $200 billion in hurricane losses since 2022. Hurricane Melissa, projected at Category 3 or 4 strength with winds up to 145 miles per hour and storm surges reaching 18 feet, threatened communities still recovering from previous storms. Official records confirm that 15 to 20% of homeowners were uninsured, and more than 30 insurance carriers had left the state before Melissa even made landfall. Emergency orders led to the largest evacuation since Hurricane Irma, but the ultimate cost to the housing market remains unknown until final damage assessments are released. What is clear from state filings and federal reports is that Florida's insurance system